Hi, welcome to Investment Analysis and Portfolio Management course. The title of this module is The Investment Setting. The section goal is to understand the fundamental of investment management, and the module goal is to understand definition of investor, assets, and markets. This initial material discusses several topics basic to the investment and portfolio management. So, this topic is about making sure you have a fair idea of the entities that are involved in markets, how they are incentivized, and how they operate. So, what is an investment? From a formal definition of an investment, it is a current commitment of dollars for a period of time in order to derive future payments that will compensate the investor for the time the funds are committed, the expected rate of inflation during this time period, and the uncertainty of the future payments. Why do people invest and why they want from their investments? They invest to earn a return from savings due to their deferred consumption. They want a rate of return that compensates from them for the time period of the investment, the expected rate of inflation, and the uncertainty of the future cash flows. Next questions. Who invests? We call them market participants. In common language, the people and organizations that buy and sell financial assets as part of their normal business. Investor can be an individual, a government, a pension fund, or a corporation. Firms are net demanders of capital. They require capital or money from suppliers of capital to finance their business and operations. On the other hand, households typically are net suppliers of capital. They purchase the securities issued by firms that need to raise funds. The last, governments, can be borrowed or lenders. To understand investments, you need to understand the entities making investments because each of these participants have different incentives and constraints. Why they invest in is investable assets. For examples, corporations invest in plant and equipment, individuals in stocks, bonds, commodities, or real estates. And where they invest, we call it markets. For example, exchange and over-the-counter market. Let's discuss financial markets. By definitions, financial markets include any place or system that provides buyers and sellers the means to trade financial instruments such as bonds, equities, currencies, derivatives, and so on. Financial markets facilitate the interactions between those who need capital with those who have capital to invest. For example, money markets are made up of short-term, marketable, liquid, low-risk debt securities. On the other hand, capital markets include longer-term and riskier securities, which divided into 4 segments: longer-term bond markets, equity markets, and the derivative markets for options and futures. Next, we're going to talk about portfolio management in brief. It's the application of investment principles and philosophies to the management of wealth using financials and real assets. When we talk about assets, real assets are the assets that a business or investor owns, such as land, building, and more. On the other hand, a financial asset is liquid assets that one can easily or quickly convert into cash, such as stock, bonds, securities. In applied portfolio management, we should have core belief that we call it an investment philosophy. It is a coherent way of thinking about markets, how they work, as well as investor behavior. A portfolio is a collection of financial investments like stock, bonds, commodities, cash and cash equivalents, including closed-end funds and exchange-traded funds. Investment process basically is divided by 2 processes: asset allocations and security selections. Asset allocations is a choice among broad asset classes. For example, stock, bonds, real estate. While security selections choice of securities within each asset classes. Most investors are risk-averse, but to different degrees, and it also varies across time. A risk-averse investor is an investor who prefers lower returns with known risk. In other words, among various investments giving the same return with different level of risk. These investors always prefer the alternative with least risk, or we call it higher expected returns requires higher risk. The longer an investor time horizon, the greater the proportion of the portfolio in risky investments, as a longer investment horizon can generate much greater profits than a short-term investment. There are frictions that are encountered when executing an investment strategy. The most prominent friction is trading costs. And there are three big frictions, such as brokerage costs, which is the most explicit of the costs that any investor pays, but it is usually the smallest component. Bid-ask spread, which is the spread between the price at which you can buy or sell an asset at a point in time, and price impact, the price impact that an investor can create by trading on an asset and increasing its supply or demand. So, what to consider? Don't forget about tax. It does matter. And also inflation. As investors expect a change in prices, they will require a higher rate of return to compensate for it. In addition, margin investing that enables investors to increase their expected return, and also risk. Okay, we have a quiz for this material. The means by which individuals hold their claims on real assets are A. Investment assets, B. Depository assets, C. Derivative assets, and D. Financial assets. Please take a look at the answer and see you in the next lecture. So this is the end of this module. See you later.